Silver should not be here, sitting near $93, all-time territory. While copper cools, oil backs off, gold consolidates. Silver just keeps grinding sideways at levels that should have cracked by now. That's not weakness, that's information. If you're holding silver, watching this rally, or stacking physical, you're watching pressure build in real time, not hype, not a forecast. Pressure you can actually measure. Here's what most people miss. When price refuses to fall, despite all the reasons it should, the constraint isn't sentiment, it's supply. I want to walk you through two patterns that repeat across every tight commodity cycle. You've seen them before, you just didn't have names for them. One is what I call the reluctant breakdown, the other is the physical first squeeze. And by the end of this, you'll know exactly what to watch this week to see whether silver keeps grinding or finally snaps. If you're here now, you're already ahead of the crowd waiting for someone on TV to explain it after the move. Quick thing before we go deeper. If you want to stay inside this loop, hit subscribe. We don't chase headlines here. We track pressure before it shows up on charts. Think of this as a watch crew, not a trade signal service. And drop watching in the comments if you're tracking silver this week. I want to know who's actually paying attention. Now let's talk about why 93 matters. Silver doesn't hover. That's not its personality. It's volatile. It spikes, it crashes, it mean reverts fast. That's been the pattern for 2 decades. When it rips, it usually gives back 15 to 20% within weeks. When it stalls, it normally chops violently. This time, it pushed from the mid-80s into the low 90s and then just stopped moving down. Pullbacks have been shallow. Dips get bought aggressively. There's been profit-taking across commodities, and silver's held. That's abnormal. Here's the hidden layer most people ignore. Physical premiums are rising, not collapsing. Lease rates in the wholesale market are sticky. Warehouse stocks aren't flooding in the way they usually do after a rally. Dealers are using phrases like delayed restocking and limited availability. If this were a speculative blow-off top, you'd see the opposite. Premiums would compress. Physical would flood back. Long positions would get crowded and overconfident. Instead, what you're seeing are reluctant shorts and tight physical flow. Sit with that for a second. Price that won't fall is information. Let me name what you're actually watching. This is the reluctant breakdown pattern. Here's how it works. Selling pressure exists. It should flush the market. Every technical signal says price is extended, overbought, and due for a reset. Bears are positioned, profit takers are active, but price just won't go down. Not aggressively, not cleanly. It drifts lower, finds a floor, grinds back up, over and over. The metaphor that usually clicks is this. Think of price like water trying to drain through a valve. If the valve is wide open, water rushes out fast. That's a normal correction. But if something's clogging the valve, the water only trickles. Pressure builds behind it. That clog is real demand meeting limited supply. This isn't theory. You've watched this pattern play out before, even if you didn't label it. Oil before its 2008 run, copper in 2020 before it doubled, wheat during supply shocks, uranium before its last breakout. Same structure every time. Price refuses to flush despite bearish conditions. Then it doesn't just hold, it accelerates. Why does this repeat? Because markets price visible information quickly. What they price slowly is flow. Physical tightness doesn't show up on a chart until it's already binding. This isn't advice. I'm not telling you to buy or sell anything. This is pattern recognition. The job isn't to predict what comes next. It's to understand what's happening underneath. Could silver reverse tomorrow? Absolutely. Markets don't move in straight lines. This isn't a guarantee. It's a conditional setup. And this is where most people get shaken out, right as the reluctant breakdown starts resolving. They see shallow dips, assume the rally is over, and exit early. Then price rips without them. So the real question isn't whether silver goes up or down. The real question is whether the valve is still clogged or starting to clear. When you see a market that should break down but won't, you're not watching sentiment. You're watching supply constraints forcing price to hold against gravity. Now, let's connect that to the second mechanism, because this is where it gets real. The physical first squeeze. Silver trades in 2 worlds. There's the paper world, futures, ETFs, swaps, liquid, fast, and abstract. Then there's the physical world, bars, coins, industrial offtake, refinery capacity. Slower, messier, and constrained by reality. When physical tightens first, the paper market doesn't notice right away. Futures still trade smoothly. Spreads look normal. Liquidity seems fine. But in the real world, dealers start rationing. Premiums tick up. Mints slow delivery. Refiners hit capacity. Lease rates stop falling. Physical tightness moves first. Paper reacts later. Picture yourself as a market maker. You're short 500,000 ounces through futures, planning to cover into weakness. But when you try to source metal to manage your exposure, there's nothing available at spot. You're paying $2 or $3 over spot just to get silver. At that point, you're not selling anymore. You're covering, reluctantly. That's the squeeze mechanism. It doesn't start with a headline. It starts when flow breaks down in warehouses, mints, and dealer networks. By the time it shows up in positioning data or retail chatter, the move is already underway. I'm not telling you this is fully happening right now. I'm showing you the pattern so you recognize it if it develops. What we're seeing are hints. Premiums haven't collapsed. Lease rates are holding firm instead of relaxing. Warehouse inflows aren't surging the way they usually do after a rally. That's not confirmation. It's a yellow flag. Here's the key connection. If physical stays tight while paper tries to cool, you get a compounding effect. The reluctant breakdown meets the squeeze. That's when grinding turns into gapping. Could this resolve peacefully? Sure. Physical could loosen. Premiums could compress. Shorts could cover without drama. Markets do that all the time. Your job isn't to predict which path it takes. Your job is to know what signals tell you which path is unfolding. You can't know timing. Only structure. This isn't a top, it's a test. And this is where most people ask the wrong question. They ask, should I buy silver or sell silver? That's not the decision point. The real question is whether pressure is building or releasing. If pressure is building, if physical stays tight, premiums rise, warehouse stocks stay lean, lease rates hold, then shallow dips aren't exits, they're stress tests. If pressure is releasing, if premiums compress, dealer language shifts, inventories surge, then the structure is changing. The reluctant breakdown resolves lower. The squeeze never materializes. Misreading this phase doesn't just cost profits, it costs positioning. Exit too early during building pressure, and you miss the acceleration. Hold through a releasing market, and you ride it down. That's why structure beats price. Silver could grind sideways for 2 more weeks and then rip $10 in 3 days. Or it could chop here, roll over, give back $8, and reset the entire setup. Same price action. Completely different outcomes depending on what's happening underneath. So, don't ask me where silver is going. I don't know. No one does. Ask instead, what tells you whether the valve is still clogged? That's the difference between guessing and monitoring. Now, let's talk through the paths this could realistically take. One path is continuation through grind. Premiums tick higher, lease rates stay sticky, warehouse stocks stay flat or decline, dealers keep talking about limited supply. Price consolidates tightly, dips shallow, and then grinds higher over weeks. In that path, patience wins. Chasing every dip and selling every rip just gets you chopped. Another path is a sharp pullback, maybe 6 to 10%, driven by profit-taking or macro jitters. Everyone screams top, but premiums don't collapse. Physical doesn't flood back. Wholesale participants don't panic. That's the classic bear trap inside a squeeze. Weak hands get shaken out. The move resumes. The third path is acceleration. Something breaks. Maybe industrial demand surprises. Maybe delivery stress shows up. Maybe shorts panic. Paper scrambles to catch up with physical reality. Silver gaps $5 or $8 in a session, and suddenly everyone's talking about it. No guarantees, just asymmetries. Any of these can fail. Markets don't owe you anything, but if you know what you're watching, you can adjust as structure shifts instead of freezing in confusion. Here's what I'm personally watching this week. Not advice, just signals. First, physical premiums at coin and bar dealers. Normally, premiums compress after rallies. $2 or $3 over spot is typical. Stress shows up when premiums stay elevated or rise to $4, $5, $6 while price goes sideways. Second, lease rates in the wholesale market. Normally, they fall when demand softens. Stress shows up when borrowing costs stay firm or rise. Third, warehouse stocks. Normally, after rallies, inventories build as sellers deliver into strength. Stress shows up when stocks stay flat, decline, or only trickle in. Fourth, near-month structure. Silver usually trades in contango. Stress shows up when contango flattens or flips to backwardation, where a spot costs more than future delivery. And finally, dealer language. Steady supply and normal lead times are normal. Delayed restocking and limited availability are not. You don't watch these in isolation, you watch them together. If premiums rise, lease rates hold, and inventories stay lean, pressure is building. If premiums compress, lease rates fall, and inventories surge, pressure is releasing. If signals conflict, you're in transition. Don't force a read, and respect the risks. Silver is volatile. Leverage can wipe you out even if you're right later. Physical is harder to exit than paper. Macro events can override fundamentals temporarily. Your approach, your capital, your timeline. Here's where this all lands. If you're watching structure instead of headlines, you're already ahead. You're not guessing whether silver is a buy or a sell. You're monitoring whether pressure is building or releasing. You're watching flow, not noise. That's the edge. Recognition, not prediction. Markets don't move when everyone agrees. They move when pressure outlasts patience. The reluctant breakdown teaches you that price refusing to fall is information. The physical first squeeze teaches you that tightness shows up in flow before it shows up on charts. These patterns repeat. Different assets, same mechanics. If you stayed with this, and you know what you're watching this week, you're far less likely to get shaken out by noise. Drop a comment and tell me which signal you trust most when markets tighten. Premiums, inventories, lease rates, dealer language. Let's compare notes. And if you've lived through a physical squeeze before, silver, oil, copper, share what broke first and what lagged. Pattern libraries beat theory every time. Subscribe if you want to stay inside this signal loop. We'll keep tracking this as it unfolds. Final thought. Price that won't fall is information. Physical tightness moves first. Paper reacts later. Don't wait for the headline. Watch the structure. If you're watching now, you're already ahead. I'll see you in the next one.